Is the Fed going to lower interest rates in the December 10 meeting? I think the answer is yes. And in this video, I'm going to explain why. First, I'm going to look at the CPI, and particularly at the latest print, which happened on October 24th during the US shutdown. This index was the only one released during the shutdown. And the reason why it was the case is because some of the benefits that affected tens of millions of Americans, they relied on this economic indicator. So that's why the BLS, they did the exception and they released the CPI because the September data was gathered. It came in colder than expected. So the consensus projected 3.1% inflation, and the data came in showing a 3% increase. So that's 10 basis points below the consensus. This is key because September was the first month without the tariff pause, which means we had the tariffs. And everybody was panicking that, we're going to have a crazy amount of inflation for foods, for cars. It wasn't the case. Take a look at the table in the screen. So I'm sure if you can see, I think you can. The main contributing factor for the inflation in September was gasoline. You can see 4.1% year-over-year increase. You can see, month-over-month increase. You can see the other items, particularly food or new vehicles or used car and trucks, they actually didn't contribute at all. In fact, the used cars were actually deflationary. So overall, the tariffs are not being fully passed to consumers, and this is key. So some of the corporations, and I'm not really, bullish on consumer defensive stocks, mostly because I think that they are taking the hit on tariffs. I'm not bullish on car companies either. Tesla, not much because humanoids are quite far away. But overall, I think the corporations are absorbing the tariffs and the consumers are not fully paying the cost of the tariffs. What does it mean? Well, if you look at the expectations from the Cleveland Fed, we can see that the core CPI, and let's look at the CPI because core CPI is CPI less food and energy. So if you look at the CPI, it's going to be 3% in November. And in October, the expectation from their nowcast is 2.96. This means that there is no increase in inflation from that 3% rate. This is good news because if inflation stays where it is, even if this value is above the 2% target from the Fed, which I think it's unrealistic and it's quite, I don't know, I think they're going to have to revise that target because it's already off. I don't think that inflation is going to go back to those levels unless there is something very bad happening in the US. I don't predict that's going to be anytime soon. So if the CPI is going to be moderately high, but it's not going to increase compared to the September read, then the Fed are going to have a very compelling reason to look at unemployment. So if unemployment is going to increase and inflation is going to stay around, let's say 3%, I think they're going to cut rates. So what happens with employment? Before I go into that, I just wanted to do a quick touch base on why the CPI is going to stay the same. Two of the main factors that are affecting the CPI are transportation and shelter. Transportation, you can see the Mayhem Used Vehicle Value Index. It was down 2% month over month, and year over year, it was flat. What does it mean? It means that we have one of the factors, in fact, this was deflationary in the last report, negative 0.4% month over month. This is not going to lead to inflation, which is great news. If you look at shelter, we have the national median rent dipped by 0.8%. This is month over month in October. And experts are suggesting that this is likely going to continue until the end of the year. Now, that is significant, especially when you look at the rents year over year, which are down almost 1%. So shelter is not going to be an issue either. Now, if we focus at the jobs, the latest employment situation summary that we have is from August. The data was not published for September, unfortunately. I think it's going to be published next week, and possibly that's when the markets are going to regain the confidence that they lost after the US government shutdown came to an end. If we focus at the value, we had positive 22,000 non-farm payroll jobs that were reported during the month, and overall the unemployment rate is 4.3%. This is high. If you look at what has been going on since mid-2023, you can see an increase in the unemployment rate from 3.5% all the way up until 4.3%. What is quite interesting about the chart is that the unemployment rate has been, stagnating around the 4.2, 4.3 value since this is over a year, July 2024. So I think that the figure we're going to have, for likely, I would say September, but most importantly, November, because I think unemployment is not going to be published for the month of October, as Kevin Hassett said, because the surveys were not sent. I think that figure is going to be as high as 4.5%, and that is going to lead to the Fed to, lower interest rates, even if inflation is above their targets. Inflation, as I said, there are a lot of deflationary items, and I would expect inflation to come in at 3%. As for unemployment, it's likely going to increase. Why? You have the Challenger reports, and the Challenger report posted on November 6th showed 153,000 job cuts announcements in the month of October. That's a lot. How much is that? That's the highest month in terms of announced job cuts since 2003. So it seems that AI is actually leading to a decline in employment. Of course, announced job cuts is not the same as job cuts because these are just announcements. However, I'm already seeing clear signs that AI is leading to a decline in employment. And I think this is very bullish in the very near term. In the mid-term, this can affect consumer spending. Very dangerous. But I think that's going to happen second half next year. Until then, there is plenty of room for the bull run to continue, in my opinion. Now, looking at the ADP, we have mixed data. So in October, it announced 42,000 jobs that were created in the private sector. However, if you look at September, you can see that the net amount was, negative 29,000. So 29,000 jobs were lost in that previous month. If you look at the one-year trend, it looks very bad in the private sector. You can see the number of, private jobs have been declining a lot. And if you look at the past 10 years, well, here you have the pandemic. So let's look at the past 5 years. You can see that there is quite of a slowdown in the private sector. So this will give the Fed, particularly the chair, Jerome Powell, some good reasons to lower the interest rates. You can see here, these are the minutes of the last FOMC meeting. This was on September 16th. They said expectations for the unemployment rate increased only marginally overall, not a lot. I think this wording is going to drastically change in the December 10 meeting. So far, the markets are projecting 50%. It's a coin flip for another rate cut in December. And if you look at the CME group projections, it's about the same. It's 50% overall. What does it mean? Well, take a look at the SPY, right? So I'm going to use the hourly chart. If you zoom out, you can clearly see here the convergence, all right, of a triangle. You can see the triangle, it's not a coincidence, it's converging on December 10th, which is exactly when Jerome Powell is going to decide what they're going to do with the tariffs, with the rates. I think until then, this is going to consolidate around this area. So high 600s. Any break below this support will be very bearish, in my opinion, in the short term. Again, longer term, I think the upper trend is going to sustain. But if the share price breaks this level, if I have any short-term options, I will begin to consider taking some action in regards to that. Now, if it breaks above this trend line before the meeting, that's going to be bullish. And I do project that either on December 10th or before, this is going to break to new all-time highs. And overall, I feel positive on the macroeconomic picture in the US, and I do expect the SPY to break the new all-time highs. Same for the Qs, the SPX. I'm quite constructive on the outlook. However, it will all depend on where the CPI is for the month of November and where the unemployment rate is, again, for the month of November. Until then, I do project that we're going to have some volatility. So this is going to lead to some consolidation, and I will be hesitant to begin a long position right now, even though I'm very bullish that we're going to have a rate cut. If the unemployment data comes in way hotter than expected, I'm talking 4.7%. And the reason I'm saying that is because, well, you can already see there is extreme fear first in the market. And most importantly, you can see the Challenger report, year to date, we are at 2020 levels in terms of announced job cuts. If unemployment comes in higher than 4.5, I will be a bit hesitant because the market is going to be spooked. Of course, you don't have people working, they're not going to consume. CapEx for the hyperscalers is going to I wouldn't say disappear, but it's going to likely be reduced because, as you know, the CapEx mostly, not entirely, but mostly is being funded by by operating cash flows. And some companies are already taking debt in terms of convertible notes. So overall, I'm, let's say, cautiously optimistic, and I would expect the trend to break the new all-time highs going into the December 10 meeting, possibly after that. That's it. Let me know your comments in the section below, and thank you for watching the video.